Good afternoon, everyone, and thank you so much for joining this webinar where we'll be reviewing the results of the 1Q19 MTI quarterly forecast report and talking about the latest developments in the economy in general. So I thought I'd start us by introducing kind of the big picture overview of what we see going on in the US macroeconomy by looking at the benchmark for economic performance that I believe is most important to MTI member companies. So in this particular slide, I'm showing you the forecast and the current performance and past performance for the U.S. Industrial Production Index. I mentioned this is our benchmark for the industrial economy. I think this is a much better barometer for the type of market conditions that MTI member companies are operating in compared to something more general like GDP. And so we use this as the basis, kind of the comparison for what you are likely to see the reality of the world around you over the next 12, 24, 36 months into the future. So I'm showing you this information in a couple of different ways here. On the left-hand side, you can see is the value of the U.S. Industrial Production Index on a 12-month moving average basis, going back all the way to 2006. And on the right-hand side is the 12-12 rate of change. That's our rolling annual growth rate. We're basically taking the last 12 months of data and comparing it to the same period from a year ago and then plotting that growth rate over time. So a couple of things I want to point out to you right off the bat. Here, this is the Great Recession. You can see it was a very significant decline in the industrial economy, nearly 14% year over year at the bottom there. You can see that we have recovered and we have been growing since that period of time, certainly for the following 5 years, but we never really managed to surpass the pre-recession peak with another downturn in the industrial economy occurring during the 2015-2016 timeframe. And that's represented by this dip in the moving average here, as well as the fact that the rates of change on the right-hand side of the chart actually dipped below the zero line and spent the better part of 2015 in negative territory. That, of course, was correlated to the massive decline in oil prices when they dropped from over $110 a barrel to about 26 at the low point in February of 2016. It also coincided with a significant decline in other commodity prices, steel, copper, aluminum, and that reflected a general environment of weak industrial demand. Now, it's interesting to note that since this low point that occurred in mid 2016, we have been on a tear. Economically speaking, the industrial economy is now in its 30th month of rise, and that is really unique and almost unprecedented, I should say. Understand that when an industrial economy recovery happens and when we enter the positive side of the business cycle, when rates of change are moving in an upward direction, that typically lasts anywhere between 13 and 19 months on average. And you can see that was the case certainly at the recovery period from the Great Recession. We had a low point here in late 2008, and that was extended through the late 2009 timeframe and early 2010, I should say, as well, as the industrial economy recovered. Then we look at the latest rising trend that has been going on for more than 2 years now, and it's truly almost unprecedented in its nature. It does reflect in part that we have stimulated the economy with tax reform, with other policies of the current administration. But as I'll show you further down in the slide deck, that stimulant, that kind of artificial growth streak that we've extended through government intervention is coming to a close. We're starting to see the effects of tax reform fade and wane, and we certainly don't expect them to carry on into 2019. And as part of that expectation, you can see our forecast for the industrial economy represented by these teal bars here. So we are currently awaiting an imminent cyclical peak in the U.S. industrial economy. We believe that that's going to occur in the first quarter of this year. And then the economy will transition to the backside of the business cycle. That doesn't mean that we're going to have an outright recession in 2019. It does mean that the growth rates will slow quite dramatically over the next 4 quarters. Currently, U.S. industrial production is up 4% on a year-over-year basis. This is with data through late 2018. We do expect that as the December and the January number comes out, that might raise a little bit to maybe 4.1, 4.2%. But beyond that, it's going to start to decline. And over the course of 2019, that decline will persist, resulting in essentially a flat year for the industrial economy. We are expecting growth of just 0.5% by the time everything is said and done. And we won't end there. We are actually calling for some further decline beyond that, but that decline will be concentrated in the first half of 2020. So what you can see here by the forecast is that we're expecting 2 to 3 quarters of negative year-over-year performance for the U.S. Industrial Production Index, and that does mean the dreaded R word. There will be a mild and brief recession in the U.S. industrial economy as we get into that first half of 2020. The good news is by the end of that year, we will have reached the turnaround point. We'll be back in a recovery trend and be into positive territory once again by the end of 2020. You can see our forecast here is for 0.7% growth next year. So essentially, in your mind, you should prepare yourself for a slowdown, for certainly lower levels of demand and industrial activity that we experienced in 2017 and 2018, but also realize it's not going to be anything like what we went through in 2015, 2016, nor certainly what we experienced in 2008, 2009. Really, what this is going to do is it'll give you a chance to catch your breath a little bit, to start thinking about how do you position yourself for that next rising trend in the economy, which we certainly expect to develop over the latter part of 2020 and carry through into 2021. You can see our forecast for U.S. industrial production growth is for 2% by the time we get into that 2021 timeframe. So how do we know? How do we know that that's what's going to happen? What makes us believe that despite the very positive momentum that is existing right now, that we are going to have this transition to the backside of the cycle? Well, we've got a system of leading indicators that consistently and as a body of evidence tell us that the cyclical rising trend is imminently going to end, and then we'll see this transition to the back of the cycle and some potential negativity down the road. So a quick kind of refresher on how our leading indicator works. Here I've taken two data series. The blue line is representative of a sample set of industry data. That's also the 12/12 rate of change, the year-over-year rolling growth rate. The orange line is a monthly data series for the ITR leading indicator. This is a predictive data series that foretells what the blue line is going to do. Let me explain to you how. You can see that the peak in the orange line occurred in May of 2010, but the peak in the blue line didn't happen until May of 2011. And that suggests that there is a 12-month lead time between the leading indicator and the industry data that's represented by the blue line. And I can see this 12-month lead lag relationship hold true through the various low and high points in the business cycle. So here, this low predicted this low, the high here called for that high, the low here predicted this low, and so on and so forth as we go through the various business cycle peaks and valleys. Now, what that allows us to do, once we've identified that lead time, is we can take the latest 12 months of data, going back all the way to December 2017, and keep in mind, this is not a forecast, this is not conjecture, this has already taken place, and we can physically push this series forward and leverage that last 12 months of data to predict what is going to happen in the blue line over the next 12 months. So leveraging this methodology, why is it that we're calling for business cycle decline in the U.S. industrial economy and then eventually some negativity? Let's take a look at some of the evidence here. First, I want to show you the G7 leading indicator. This is using a 1/12 rate of change, which is the month-over-month growth rate, and is representing the economies of the largest developed nations. Essentially, the U.S. is part of this, but so is UK and Germany and France and Canada and Japan and several others. And you can see here that this G7 leading indicator has clearly gone through the peak already and has transitioned to the backside of the cycle, eventually capitulating and going into negative territory. So that's the first sign that the slowdown is already happening in much of the world around us. We just haven't quite felt it yet here in the United States. Turning our attention to the US, we look at the US Purchasing Managers Index as a great leading indicator. And there too, you can see that the rates of change have been declining since early 2017. And really, the latest couple of months of data are quite negative. That certainly points to some of that negativity that we expect in the US industrial economy as we get into that early part of 2020. The stock market is not always the best indication of what's going to happen with the economy, but certainly from a timing perspective and from a cyclical perspective, there is a relatively good correlation here. And you can see that clearly the momentum, the upside movement in the stock market, as represented by the Wilshire Market Cap 312 rate of change, which is the quarter over quarter growth rate, that too has gone to the backside of the cycle. It's touching the 0 point right now, so not quite negative yet, but certainly indicating that things are going to be slowing down for the US industrial economy. And probably my favorite one to look at is the JP Morgan manufacturing indicator. Here too, I'm looking at the 312, or the quarter over quarter rate of change. And that also has been in decline on a rate of change basis, with the last several months of data now going into negative territory when you look at it on that 312 basis. So, in other words, what we have is a body of evidence that has formed that, with a high degree of confidence, I can say, based on this input, we can expect that transition to the backside of the cycle and potentially some decline as we get into that early 2020 timeframe as well. Here, just looking at what's happening in the rest of the world real quickly, the EZ Composite PMI, that's the Eurozone Composite Purchasing Managers Index, that's the blue line, that is currently down 12%. The Europe Manufacturing PMI is down more than 15%, and the JP Morgan Global Manufacturing PMI is down 5.5% versus last year's levels. And that all shows you, again, that the leading indicators from around the globe point to this worldwide economic slowdown that is happening around us. We just haven't felt it yet because of that extension in our own rising streak that we've been able to manufacture, essentially, by leveraging tax reform and the associated increased levels of capex and business investment that we saw over the course of 2018. But going to that subject of capex, there's also quite substantial evidence that the peak is already in and that we have transitioned to the backside of the cycle in terms of investment. So here what I'm showing you is a series called Non-Defense Capital Goods New Orders Without Aircraft. It's essentially our barometer for business-to-business activity and really reflects the amount of capex that's out there. So we do see that there was a slight positive impact from the tax law that showed up here. It extended this period of elevated growth beyond what normally would have occurred. But now we can see that it's already starting to turn down on an annualized basis. That's the 12/12, the year-over-year growth rate. And the fact that our 3/12 has peaked and has downward past the 12/12, and today it remains below the 12/12, suggests that over the next 6 months or so, we will see a further deterioration in the rate of change for business-to-business activity, and that corresponds to, of course, lower levels of capex being put into the marketplace, driving your business forward. So what do you do? What do you do in light of these expectations that we are going to be transitioning to phase C, which is that slowing period of growth, that backside of the business cycle? What do you do in terms of your own business? I think you've got to look back at your own performance historically. Look at the parts of your business where the demand was healthiest during previous phases in the economy that represented slowing growth, and then make sure you know which competitive advantages your customers will relate to, will respond well to, that will encourage them to continue doing business with you as things slow down around them, in some cases, some quite dramatically, and also as they become more conservative and less willing to take on risk. Other things that you should think about during phase C: cash management for proper allocation. Make sure you start building up that cash reserve and implement some tighter inventory control measures if that is applicable to your business. The third thing that I'll say you have to do is really ask yourself, what shouldn't I be doing? Identify products and services within your portfolio that potentially represent losers, essentially not performing well, and divert resources away from those types of products and services and to the more profitable parts of your company. And finally, You have this report that I'm about to share with you for MTI, but develop your own rates of change for your own business to understand when that bottom is going to happen so that you know when to pull the trigger on the next level of investment in your own company as we head into 2020 and certainly into the growth trend that is going to be there for 2021. So now I'm going to switch gears a little bit and share with you the results of the first quarter 2019 MTI quarterly forecast report. The first thing I like to always do when we look at this information is take a look at the latest data developments over the last 3 months since the last time we talked. And essentially, I'm happy to report that as the marketplace, these MTI reported average monthly sales data, has behaved very much in line with what we were expecting to happen. Our forecast on the 12/12 rate of change, the annual forecast, was calling for 11.5% growth by the end of the year, and that's certainly very, very close to what we saw happen. But also, what we saw happen was a fairly substantial drop in the monthly data. And you can see that visually here on the bottom. You can see that there were declines both in December and in November relative to the strong levels we saw in August and September and October. In fact, the December value of 518.9 thousand, this is the average monthly sales per plant, was one of the lowest levels we've seen since early 2018. You have to look back towards January and February of last year in order to see a level of activity on par with what we have going on right now. And it's certainly much slower than what we saw over that late spring, early summer period in terms of that data. So given this dynamic, and the fact that the data has behaved largely the way that we expect, we also see that the forecast that we have put in place for MTI monthly sales remains valid. And we have extended it because our expectations based on leading indicator input and on the developments with the data itself haven't changed dramatically. So we do expect, just like what we saw in the overall macroeconomy, that the 1Q19 timeframe will represent the peak growth rate for MTI average monthly sales. And at that point, we will transition to the backside of the of the market for your industry, eventually capitulating in some mild negativity as we get into that mid-2020 timeframe. So very much aligned with our expectations for the overall macro industrial economy. You can see that the rates of change are already starting to signal that the slowing is going to be happening soon. The 1Q19 number on the 3/12 is 11.9. That's below the 12/12. That really highlights the fact that the turnaround is imminent. And then we have some more overtly negative numbers on the quarterly data with our expectations. And that will lead to this phase C type of behavior over the next 4 quarters or so as we transition into the back of the cycle for the MTI average monthly sales forecast data. Looking at the relationship between the MTI average monthly sales and some of the leading indicators I talked about in my slides earlier, you can see that the cyclical pattern is actually quite similar. So here I'm plotting the yellow line. That's MTI average monthly sales, including the forecast that we have in place. And that is being plotted versus the U.S. Industrial Production Index. That's the blue line. Along with its corresponding forecast. You can see that typically these lines move very much in sync with one another. The lead time for the blue line, or the low points and the high points, tend to occur just a few months earlier than the peaks and the valleys occur in the yellow line. And that's basically what we're expecting to happen here as well, is the extension of the trend for MTI average monthly sales is going to go a little bit beyond what we see in the macroeconomy. And that will, of course, continue through the next low, where it's happening almost at the same time frame, but perhaps a couple of months apart. Our forecast, as I mentioned, for the U.S. industrial economy, relatively flat years for both 2019 and 2020, and then that return to positive growth, that accelerating pattern as we get into 2021. The last thing that I want to review with you really quick here is the non-defense capital goods new order series, that business-to-business activity metric. Currently, it's still up 6.7%, so a very strong level of performance. Again, you can see the cyclical relationship is actually quite strong between this data series and MTI average monthly sales. And when we look to the forecast values, you can see that our expectation for 2019 is a little bit more negative when it comes to that CapEx spending trending. We've seen a lot of signs from the business community that things are really starting to cool around them. For instance, if you look at the quarterly statements and the earnings calls, or both in Q3 and in Q4, a vast majority of corporations, although they reported solid earnings and in some cases beating expectations up to that point in time, their forward-looking experience was that of negative earnings guidance. That basically means that they're expecting to be less profitable as we get into 2019, and that means less profits to invest in additional type of capex activity, really resulting in a slowdown of both capex and business investment, and their corresponding slowdown that we expect to see in the average monthly sales data for MTI. But again, getting back into the future, think beyond the trough. The trough isn't scary. The trough is an opportunity for you to catch your breath, for you to plan for that next rising trend that's going to emerge by the time 2020 rolls around. And you can see our forecasts for CapEx and for business-to-business activity for both 20 and 2021 are actually quite favorable. So ask yourself not what you should do differently just for the next 12 months as you prepare for this period of slowing economic activity all around you, but rather beyond that. What do I need to do, and at what point in time do I need to do it in order to position my business correctly for that next rising trend that we're going to see happen in 2020 and 2021? So just a final review of the forecast here. We are expecting that this slowdown will carry you through all the way into early 2020. There's going to be a couple of quarters of negativity, down year over year in terms of the average monthly sales forecast, a return to positive growth, and that will carry all the way through into late 2021, although eventually by the second half of that year, you will see another period of slowing growth. And looking beyond that, one other thing I wanted to mention to you before we part for today is that typically when we forecast the economy, we highlight our forecast for the next 3 years. I did want to mention to you that we're currently looking at a much more meaningful, more robust downturn emerging right around the 2023 timeframe. So when you're talking about longer term planning, 4 or 5 years into the future, understand that this mild period of contraction that we're expecting in the first half or midpoint of 2020 will eventually be replaced by positive growth. But on the back of that positivity is a more meaningful downturn when we get into that 2023 timeframe. So that kind of wraps up the content that I wanted to review with you today. I hope you've gotten some value out of it. If you have any questions, certainly feel free to send them to me. I'm A.Chosovsky at itreconomics.com. Certainly feel free to leverage Tom, and he can put you in touch with ourselves. And I wish you the best success in 2019, and certainly understand that the difference this year, the one thing that I would point to that would be different than what you experienced in 2018 is that there's still going to be opportunities. You can still achieve growth targets that you set for yourselves, but it's going to be much more dependent on what you do internally rather than just expecting the economy to be the tailwind in your sales. So it's the marketing initiatives, it's the market share gain, it's the promotions that you end up running with your customers. It's the close relationships that you've built with your customers. Leverage that to achieve the success that is going to be possible for you this year, despite the macroeconomic deceleration that's going to be happening all around you. Guys, thank you so much for your time. I always enjoy talking to you, and I look forward to doing so again next quarter. Take care, and bye-bye.